Welcome to the Rodcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Hello everyone and welcome to another episode of the Rodcast. Today I'm welcoming back Ben Green, who is the principal of Atrato Capital, formerly the investment manager of the Supermarket Income REIT, who was on back in episode 73, and also Adrian Donrico. Have I pronounced that right, Adrian?
Close enough.
That's a no then. Denrico.
That'll do.
Denrico, who is the fund manager of the Social Housing REIT. So welcome, guys. Thanks very much for coming back. Welcome back, Ben. Welcome, Adrian.
Thank you.
Thank you very much.
So what led you to the Social Housing REIT? How did you become involved?
So I think most people think of Atrato as the supermarket guys because of Supermarket Income REIT. Actually, we've been a much broader investment manager for a while. We actually set up another investment trust which invested in solar panels on the roofs of commercial buildings, which actually Brookfield bought last year. And we're always looking for interesting niche strategies, mostly kind of asset backed, where we can bring on board a great team and create an interesting investment proposition. And we'd identified social housing as an interesting area actually a couple of years ago, and we had brought on board a small team to raise a fund. We did that actually against a terrible backdrop for fundraising. We had the mini budget happen on us. Obviously, Ukraine happened, so that wasn't going to happen. So we kind of pivoted to figure out what the other opportunities were in the space, and that brought us to the Social Housing REIT, where we bid to replace the manager, and we were successful in that bid. And we were awarded the mandate, which started on the 1st of January.
Fantastic. And just to kind of clarify what it is that you do at Social Housing REIT, because some people might be thinking social housing, social rents, but actually it's more down the supported living route, isn't it? Is that right?
Yes, that's right. It's specialist supported housing specifically. So that is providing they tend to be residential houses that look like normal residential houses, but they've been adapted for the needs of vulnerable adults who they might have learning difficulties, they might have physical difficulties, and the idea is that it provides them a place to live independently, and if that wasn't available to them, then they would have to be in some other form of residential care, which might be a care home or it might be a hospital. So obviously, this is a much better solution for the individual. It's also much cheaper for the taxpayer. So it's actually it's a win-win.
And why a REIT and not a typical fund? Do you want to explain kind of, I guess, the differences for the listeners about that and why this fits better for a REIT than a fund?
Yes, I think specifically it's a publicly listed REIT. So it's listed on the London Stock Exchange. I really like that structure for real estate investments of this kind, and Supermarket Income REIT was the same structure. It means that it's open to everyone to invest. It gives you daily liquidity. Now it gives you a bit more volatility because obviously if the whole stock market sells off, then usually you get a bit affected. But at the same time, I'm really not a fan of the open-ended funds at all, which sort of pretend to give you liquidity but actually don't really give you liquidity when you really want it. You can always sell shares in a listed REIT. You might not get the amount of money you wanted for them at the time if the stock market's going through a particularly bad patch. But if things are going through a really bad patch in open-ended funds, I think the lesson that history's taught us is that you won't be able to get your money back. Yeah. They get suspended. Yeah. So I really like it as a structure, and then REIT in the broader sense, in the broader term, is also a great wrapper for all UK real estate because it's just a very tax efficient way of structuring real estate investments. So if you're a taxpayer, you'll pay tax on the dividends that come out. But if you're a non-taxpayer, you just receive everything free of tax the whole way through. So it's a great structure for pension funds, for SIPs and ISAs to invest in. So we like it all round as a structure.
Brilliant. And one of the things that I always kind of associate with REITs is your net asset value, and it's always kind of talking about your net asset value. And I guess, Adrian, you probably kind of are rolling your eyes at that term. But how on earth do you work out what the net asset value is in the first place, and in terms of whether it's trading at a discount or again, when we talk about trading at a discount, that's the share price. Yeah. Because essentially, is it a sum of all the parts of all the assets, or is it actually, well, this is what, I don't know, the yield or income stream dictates that it should be? How does that all work?
Well, let Ben talk to the specifics just in terms of the NAV. I think there's a bit of a joke in the sector, like the NAV stands for not the actual value, and I think we probably we think that's probably true in a number of instances. I mean, the individual assets are valued externally by a third party. I think we have, since coming on board, we've had another look at that, and we think that our assets are probably now priced at a better reflection of where they would trade on the open market. So we're looking at that on a regular basis, and that will continue to be updated through the course of this year. There's very little liquidity in the space, so I think that's why it's been difficult to ascribe the true value to the underlying properties. But we are starting to see some more activity, and I think that'll be really helpful in terms of setting the price. And then, I think the discount is, it's a particular circumstance across all of the REITs trading at present time. I think the average is probably close to 20-25% discount to NAV, and we're looking to try and close that.
Yeah, fantastic. And so, keeping on the theme of the investment side of things, so what are some of the key metrics you look at when you're evaluating the financial health and performance of the REIT?
I think for us, the sector, specialised supported housing, it's driven by one thing. I think probably when the sector was started 10 years ago, people were looking at this as a quasi-government cash flow. 4 rent checks a year, very long-term inflation-linked leases, very passive, very hands-off. And it's probably the opposite of that. This is operational real estate. We do have long leases in place, but we're very much focused on what are the drivers of that underlying income. And fundamentally, you need people in homes. That's the real key driver of this. So we have 100% occupancy when we look at the leases that are in place, but we want to make sure that we actually have a very high degree of occupancy of the underlying residents. And so that's one of the absolute key metrics that we're focused on. So at present, we're around 86% across Soho, which is good. So just to put that in context, I think you probably need an occupancy of around 80% for it to be sustainable for the registered providers who are our lessees. And we're trying to improve on that. So I think we're looking to push that forward towards 90%. So occupancy is absolutely key. Of course, you then need the properties to be right, and that's pretty simple. Crudely, you want the right properties in the right place. You want to make sure that they're suitably adapted for the residents, so the individuals can be in there not just on a short-term basis, but they're probably going to be in there for years, some instances decades, and they might become homes for life. So we want to make sure that we've got the right stock within the portfolio. And then you want to make sure you're laser focused on the counterparties so that we're actually receiving the rents that's due on behalf of the residents so that we can pay the shareholders the appropriate money.
And that must be quite difficult looking at actually the end occupier when your lease is with the approved provider. What things do you put in place to ensure that those providers are providing what they're meant to be doing?
Yeah. Well, I think because it's operational real estate and that's how we treat it, we effectively see our 28 counterparties as our partners to deliver. They've obviously got to comply with their lease obligations, but at the same time, we want to speak to them and be in their businesses, understand the day-to-day operations of their businesses. So that's about not just understanding our properties and how they're performing, the residents that we have, but also the wider businesses of our approved providers to make sure that they're growing sensibly, they're sustainable, they've got the right governance in place. And so that's part of the scrutiny that we do on an ongoing basis, as a minimum on a quarterly basis. But where there is a challenge, where a property's not quite working, it's picking up the phone and having that conversation to try and understand what's not working well, what we can do to support them, and what we think they should be doing to try and get residents into the properties, because ultimately that's what starts to pay the cash flows, which make their businesses work. Yeah.
So obviously your investors are looking for a return, and that's why they're investing. But something like the operational activity that it's doing, there's an impact involved, and there's an element of social good. How important is impact for your investors, and do you measure it, and if so, how?
I mean, I've been surprised actually. It's a bit of a mixed bag, just in terms of there's a clear, strong impact outcome from the work that we do. So from the homes that are created, the benefits to the residents, as Ben said, there's a saving to the public purse as well. So we think it's very much aligned. There's a financial return, and it's not impacted by the social impact return. It's not not to the detriment of the financial return, but there's probably less focus on that impact than we would have expected. But we still think it's the right thing to do anyway. So we work with an external organisation called The Good Economy, and they verify, they assess, they go out there, they speak to our residents, they speak to the approved providers who are in the schemes, the care providers who are looking after the individuals in our homes, and check that everything is delivering, and they're providing wellness outcomes, they're providing social impact outcomes, that actually they're affordable at a local level, that we're doing our work in areas that do require our sorts of homes. So it's important we try and quantify that as much as possible. So we can say that for Soho, there's probably around £75 million worth of public savings every year from the portfolio that we currently have. So that's a really useful thing for us to be able to talk to policy and try and encourage more investment into the space.
I think that's a staggering number. Just say that again. So this is a fund that has a market capitalisation of £275 million, and it saves the UK government £75 million a year.
Yeah.
Well,
crazy.
Do you know what? I actually thought, a previous guest we had on was the head of Barking and Dagenham Council, and we talked a lot about kind of some of the routes to saving kind of housing benefit and things like that. And just the numbers are astronomical. And I mean, it just goes to show that how housing is infrastructure. It absolutely is. And especially something like this, even though it's so niche, it's still an absolutely enormous market, isn't it?
Yeah, and that infrastructure thing's interesting because it's a thread that kind of ties together lots of things we do at Atrato. Kind of like what we like is assets that have that sort of essentiality. Yeah. And they are effectively a form of like social infrastructure in one way or another. So supermarkets, food infrastructure for the UK. Social housing is clearly a form of infrastructure. Solar panels, same thing. So that's a sort of a thread that ties together a lot of things that we do at Atrato.
And I guess that helps the underlying asset value in that where you've got leases with providers, well, even if that provider, something happens to them and which causes a danger or risk to your lease, you know that actually the end occupier, there is still a huge demand and huge need for what that is.
Well, and that's really interesting because I think what's happened in this space is that, in the wider social housing space, particularly in the public markets, you've obviously had home REIT happen, and that's put a real downer on the sector. And this isn't home REIT at all. We've got homes that are appropriately modified. They're good quality. They've got people actually in them. Home REIT, they hadn't spent capex on actually doing up these properties. Lots of them were just unoccupied and they weren't doing what they were supposed to be doing. And I think also there's been a problem with transparency around this fund and just getting the information out. So we think you're exactly right that actually this is a really attractive, sustainable cash flow if you can do this properly. That hasn't been the perception in the market. We've sort of started to turn that around. And I think sorry, go ahead.
But what a great opportunity.
Well,
and you almost want to thank Home REIT for showing you what not to do. And here's what we need to here's what we need to get on. But I mean, you're right. There is a huge amount of controversy in the space. And how have kind of like the approved providers, but also the rent setting and kind of the enhanced rents that we heard about, how has that affected what you've put into place?
Well, I was going to say, I think another problem we had was at the beginning of this cycle in this sector. So this fund was IPO'd in 2017. We only took it over on the 1st of January this year, and there was another one IPO'd at a similar time. What was happening was people were developing these properties, and they realised there was a kind of a value arbitrage available that they could. First of all, they'd go and get the highest possible rent they could agree from the local authorities, which I suppose is natural if you're a developer. But then they would enter into a very long lease, like a 25-year index-linked lease, with quite often a related party, housing association or charity that had literally just been set up. And then they found parties like Social Housing REIT who were willing to then pay a cap value on that reflected the lease length, but didn't reflect at all the sort of credit quality of that counterparty. Lots of those counterparties ran into problems because they didn't have any operational capabilities, and they didn't have any liquidity, and they entered into these massively long leases. But what's happened in the intervening period, actually, because actually it's 8 years now since the IPO, is firstly, most of the bad apples have been kind of flushed out of the sector in terms of the counterparties. So the vast majority of our counterparties now are run by people who actually know how to operate a housing association or charity, and they've got good people with the right intentions running them. Secondly, the rents were probably too high to start off with, but actually there's been massive inflation in residential private rents in the meantime. So actually a lot of that over-rentedness, or pretty much all of it, has been eroded by that inflation, because our rents have gone up by CPI. Normal
CPI
residential,
plus one,
anyone renting a property in London knows that their rents have gone up by a lot more than CPI, right? So actually when you compare social housing REIT rents to the market, it actually looks pretty reasonable now, whereas maybe at the beginning it was 30% over-rented.
Mm-hmm.
And the same thing with capital values, right? If you look at what's happened to construction costs, again, if you're doing a big house renovation or building anything right now, you know that construction costs have gone up by a lot more than CPI plus one over the last 8 years. And so again, any kind of inflation in the capital values has effectively been eroded by the increase in construction costs plus actually some revaluation. So, we now think that actually, we own, or the fund owns the properties actually around or below construction cost. It's always a great place to be.
Yeah.
In real estate, the rents are all actually at kind of the right levels, so that's also a great place to be, and we've got a good portfolio of properties. So we think that those problems were historical. Obviously, it would have been great if the fund had bought things 30% cheaper. It didn't, but actually, if you're looking at the fund now, it's actually in a really good place.
And you brought up something very interesting that I was going to ask you on, which is kind of you're buying below replacement costs, which is always a great thing. It reduces or puts up these massive barriers to entry of competition and things like that. And one of the things I noticed actually that I was quite surprised at when I initially looked at kind of some of your stock, I was assuming it would all be in London and around there, and it's not. And a lot of it is in some of these lower capital value areas, which is not typical of a REIT. Or even any real estate fund, really. So how do you adjust to stay on top of the operations for lower value assets and a lot more of them to make up that value of your market cap?
Yeah, well, it's a good question. I mean, just picking up on, look, the properties aren't all in the southeast because the UK population's not all in the southeast. So we need to make sure that we've got a good spread, and it is useful to have that geographic diversification. So the 494 properties we have are spread across mostly England, a couple of properties in Wales and some in Scotland as well. Slightly different regimes there, so that's why we have the England focus. There are also a variety of types. So you'll range from, and reflects the needs of the underlying individuals. You'll have some bungalows for individuals who might need level access, who've got disabilities in terms of physical disabilities. You might have some shared accommodation because actually that's best for the mental health challenges some of the individuals have. So it's very much horses for courses, and we've got the right types of properties. Because they're spread around the country, you're naturally exposed to some areas which have a lower capital value. The rents don't vary as much, so there's actually a bit of an arbitrage. There's a yield pickup if you are actually buying and acquiring or developing in the regions. In terms of then servicing, it's a geographically diverse portfolio. We have 28 counterparties, so effectively those are our conduits to actually understand what's happening within those individual sub-portfolios, if you will. And we focus very much on the individual properties where there isn't full occupancy, or there is a challenge with the rental level, or there are some works that we need to do or are suggested in terms of the individual property. And then ultimately you need a team who understand that from the outside it's relatively straightforward. It's 4 walls and the roof and there's an individual in it. But they're very specific, and there are complexities to actually just the day-to-day interactions and how everything is set up and how it operates. So we've got teams who come from local authority backgrounds, who've worked in housing associations, who understand how those rents are set, how the actual schemes are operating on a day-to-day basis, and we go out and see them. So we've got a team who are actually out there on site, or various sites throughout the country, conducting over 200 inspections every year to make sure that we're comfortable that our properties are being managed according to the lease, are being managed to the appropriate standards that are set by the regulator, and that we're just happy for them to be homes for the residents who are actually in them. So it does require a team to do that. It's not something we can do individually. And very much you need to have people who understand the nuances of the space, which I think we've got. So it puts Soho in a really good position.
And do you just buy new build properties, or do you buy existing properties? And if you do, how do you discount those for capital works? Because like you said, they're all very different in terms of what they need to be. So I'm guessing you've got to do a bit of work on everything to get it up to standard. So how do you factor that in?
So I think there's a few elements to that. There's the mandate isn't to focus on new builds only or to focus on existing properties we can refurbish. It's very much about finding the appropriate scheme in the appropriate area. It's about capital discipline. We need to be focused on what's the best outcome. So if there is a value play in terms of taking some new built development stock at any point in time, then that's the preference that we will follow, and then we'll find the best opportunity that suits that. So it's very much about looking for the right timing and listening to what the market's telling us in terms of pricing. And that's about underwriting. So we have the team who have underwritten the refurbishment, so we know exactly what to look for. We can price that ourselves rather than just taking the words of a developer who might have a slightly different interest in terms of the outcomes there.
How are they motivated?
Exactly. And so it's all about protecting that downside risk. So that's very much the approach we take. But nothing's off the table. We'll very much look and assess, where we do have capital to deploy. And hopefully into the future we will have some. Then I think that's very much about finding the right opportunity at that point in time. And I think probably in this instance, actually the lack of competition in the space is quite helpful. So there's some really attractively priced new build opportunities. And we also have to consider obviously the long-term value. And you're probably starting to see a bit of a discount for non-EPC compliant properties. So current government target C or above by 2030. So you'll start to see a bit of a discount coming through. Obviously we can price that. There might be an attraction of taking properties that aren't compliant and converting or refurbishing those. But equally, if we can take the new builds, which are just, standards improving all the time in terms of construction. So if we can take those and off the shelf, they don't incur those costs, then obviously that's another part of the equation.
And then in terms of kind of working in those areas which are lower capital values, and if you do have to do that work and you do have to build something new, but it's above replacement cost, how do you factor that in terms of the value of that property? Is it purely based on the income streams? And if so, does that put more risk on your leases with your providers then?
I think you're always hyper-focused on the income. And so, yes, in those instances, if you have say more of a differential, then you'll put greater scrutiny on that covenant that you've got on the other side. I think, as Ben said, those covenants, are all relatively weak. If we're not looking at AAA covenants. So we therefore need to focus really just on what the fundamentals. So if there's a resident in situ and the rent's in the right range and the property's suitably adapted, you can be confident you don't need to look too much at the lease, and it's the values not in the lease. So I think previously people were looking at a 25-year lease being more valuable than a 15-year lease in the space. That differential's narrowed and probably dissipated entirely.
Well, the regulator doesn't like some leases over 15 or 10 years.
I kind of take the approach that actually really, our approved providers are really kind of operating a property for us and collecting rent. Yeah. And what really matters is the occupancy of the property and the rent that occupancy attracts from the local authority. And so that's what you should be valuing, right?
Because essentially it's a compass contract, isn't it? It's kind of like one of these things that if they go pop, they'll have to appoint someone else because it's such a massive need.
Yeah, so, I mean, it's literally just a feature of the regulation that Social Housing REIT can't directly let these properties to the occupants. We have to have a housing association or a charity, we call an approved provider, as the person doing it. So we have to have a lease to them. But in reality, as long as we've got an occupant who's got a long-term need to be in that property, and that's going to generate income, then that's what's really important about the sustainability of the income on that property, and it's what underpins the value of the property as well, because what you're doing is applying a yield to that rather than looking at whatever the leases you've got to your approved provider. So I'd much rather have 5-year leases, but where I've got residents in the property who need to be in there for 15 years, because in reality I've got 15 years of income minimum. Yeah. And I also know.
But will your NAV valuers think the same?
We're getting there. They're getting there. Exactly. We're getting there, and we've always been. Personally, I've always been much more focused on income than on cap values, because cap value it's just an opinion, right?
And I guess that's what your investors care about as well.
I think that's right. I mean, now obviously there are cases where the REITs that are trading at a big discount to a realisable NAV. And then people have the choice: do I accept a bid that takes it private, and I realise the NAV. Now, in reality, for Social Housing REIT, because of the stigma around the sector, I think it's very unlikely that you could sell the whole portfolio, and so that NAV really isn't realisable, in any kind of realistic way. So, part of our job actually is to rehabilitate the sector, reposition the cost of capital for the sector, and then if the right thing to do is actually to liquidate the portfolio and sell it to somebody else, maybe one of the big insurance companies, somebody like that, then that's what we'll do, because we're all about just delivering the right outcome for shareholders, and we're very focused on shareholder value. So it may be that the long term is that shareholders want us to keep it as a public company. It's obviously a great income vehicle, and it's doing a lot of social good, so it ticks a lot of boxes. But if actually what people want us to do is to return their capital and move this into private hands, we're totally open to that as well. But I don't think that's like a short term solution.
Massive concern. Yeah.
It's also just not. The problem is, because of everything that's happened in the space. There aren't people around with hundreds of millions of pounds looking to put money into this sector in one portfolio.
Yeah.
Like,
they want to dip their toe in first and see.
Well, we'd love to actually reposition the sector so that there are.
Yeah.
Because the other thing we want to do actually, is actually to create some additionality here and actually be able to build some new stock and provide more homes for vulnerable people. And at the moment, it's really difficult to raise capital from investors to do that. We've got a little bit of excess cash in the fund, and again, the debate is, should we buy back shares or should we invest in new stock? And that's the debate that we're having with the board.
What's the reasons for and against that, out of interest?
I mean, the reasons for is that the shares have got a kind of I don't know what dividend yield is today, like 7.75% dividend yield, and that so that's effectively sort of a risk-free return on your money if you buy back shares. The downside of that is that when you buy back shares, you're using cash on balance sheet, so your leverage increases, and we're already sort of at the top of our leverage range, so maybe the market doesn't like that. And then the other negative is that it's already quite a small REIT, and it'll be just taking some more liquidity out of the market. So there are a couple of quite big shareholders who are quite vocally against us doing that. On the plus side, for spending it on some new kit, we've got some relationships with some interesting, very good approved providers that we'd like to cement. And if we could fund some new kit for them, that could be very positive in giving us some other options in terms of assigning leases around in the portfolio. So it could be an operationally interesting thing to do to give us some more flexibility. But it's, as Adrian said, we're really focused on capital discipline. So it's a seriously considered decision every time we sort of come to think about that kind of thing.
From my point of view, I think you should go and buy more stock. I do. I think the upsides outweigh it. And like you said, you're a small group. You're trying to grow.
I think that there's very few parties in the space actually acquiring at this point in time. So that's why I mentioned before. There's developers who have some really good quality opportunities. I think very attractively priced relative to our existing portfolio. That'd be great to bring in. I think the shortening lease terms that we are all accepting and the valuers are starting to accept in the space is bringing in some new, stronger counterparties. So I think that would be really interesting and does help with diversification and also options as we go forward. And then ultimately, I think it's, there's the piece we touched on before. There's a huge saving to the public purse by actually sort of like bringing more of these schemes. And at this point of time, with public finances where they are, the more that we can be doing, I think is clearly a benefit to not just the shareholders, but to society as a whole.
Yeah, definitely. And kind of you touched on that about kind of discussing what investors are looking for in these shorter leases, which again, it seems to be happening in the commercial real estate market as well. But how have you found appetite from investors differs for residential compared to kind of commercial in supermarkets and things like that?
Yeah, I mean, I think the other thing we quite like at Atrato is taking a sort of slightly unloved sector and that we like and persuading investors that there is great value in it. And it was sort of the same thing with supermarkets back in 2017 when we launched Supermarket Income REIT. It was a sector where everybody thought that Amazon and Ocado were going to take over the world. And funnily enough, here we are 8 years later, and that hasn't happened. And that was sort of the message that we were getting out there, that they were infrastructure-like assets, that, you know, online food delivery was going to come out of the stores and not from centralized sheds. And here we've got a sort of a similar kind of challenge around this space specifically. I mean, I think what's really attractive about this as a residential sector is actually it's got a much higher yield than you would normally expect, you know, and that in a way is the opportunity, right? Because, you know, if this normalizes to where private rented and built rent and all those kinds of assets go to, and it probably never quite gets there because it's a bit more complex, but if it goes anywhere near that, there's a massive amount of upside in this asset class. At the same time, you know, it's for quite a few investors, they've already got a lot of residential in their portfolio, because a lot of people they've got their own
privately held.
Exactly. They've got their own rental property or whatever. Well, first of all, they've got where they live. Right?
Biggest investment most people have, isn't it? So
and then maybe they've got their own private rental property as well. So do they want to have even more exposure to that?
Yeah.
I mean, my argument for a long time has been, well, you know, why bother having, you know, a rental property that's getting you a net sort of 3 or 4, and you can't get an interest deduction anymore, and you get phoned at the weekend because the boiler's broken, when you can own a REIT that earns like a 7%, 8% dividend yield. I mean, it's kind of, and you've got a bunch of people who are experts in their field managing it. I think it's people obviously like having the tangible thing that they own, but actually economically it's very hard to make the case.
People don't realise how much like involvement and effort and stress direct investment in real estate is. And it's
exactly.
We have these cliches like tired landlords. Well, they are tired for a reason. I agree on that front. In terms of kind of the risks to investing in supported living then and social housing or social housing REIT, I kind of had thought, right, obviously the big risk is these leases with approved providers and what happens there. But it sounds like you don't feel that that's as big a deal as maybe I initially did from what you've said.
Yeah.
But what would you say is the biggest risk for an investor investing into this sector, and how do you attempt to mitigate that?
Yeah, no, you're right. So I mean, I think if you think about the risks that you have in REITs, you know, we think we've got very sustainable kind of underlying operating income because we've got good occupancy from residents. There's demand. The properties are generally speaking in good nick. The other big risk you have in these is interest rate risk. Obviously, again, we've got a very long debt structure. We've got 8 years, and the average cost of the debt is 2.75%. So you know, that's a really big benefit. We don't really have to worry about interest rates for a very long time. So the risk really is actually, it does come back to your counterparties. You know, if we had 20 counterparties who were 5% each of the portfolio, I'd be much less worried about it. But we've actually got one that's more like 30% of the portfolio. You know, and that is a risk, right? If something happens to that counterparty, then we're going to have, you know, some level of disruption to the cash flows. So we're looking very hard at potential solutions to mitigate that risk. So the problem or the risk at the moment is that our
concentration risk.
Yeah, well, the problem is that they collect the rent from the local authority. So the local authority pays the approved provider the exact amount of money that the approved provider owes us. So that all sounds good. That sounds good. But the problem is it goes into their general funds. And if they're having some big operational problems somewhere else, right, they can spend it on something else.
You need a client account.
Exactly.
There are some simple solutions, but those things that sound simple need to be agreed with the regulator. Course, and so we think there is a really good medium-term solution. And if we can get to that solution, you know, and a possible trade-off is then having a shorter lease, right? Because then we don't need a long lease. If we can get to that solution, then I think we do massively decrease the cost of capital for this sector, because if we really have got a look through to government cash flow, then this is a completely different asset class to the asset class that people think it is, right? Yeah. Now we have to put our hands up and say we don't have that at the moment because we've got the risk that the person sitting in the middle can run away with our money, which unfortunately one tenant who's just gone into a CVA was doing for most of last year. So you know, the first thing we have to do is be much more proactive about dealing with those problems than the previous manager was. You know, that problem has been known about for a couple of years. You know, and you know, we acted very quickly when we came in. We put a solution in place. You know, we can't let those kinds of problems get to that stage again. So Adrian and team are going to be laser focused on the counterparties and making sure that they're doing well. And then secondly, we've got to actively engage with the counterparties and the regulator to get this structural solution in place, but it'll take a while.
And I guess from all that, the upside is squeezing those yields and also having the rents increase over time, which would be an absolutely brilliant kind of outcome, wouldn't it?
Yeah. And we're one of the very few sectors we have uncapped CPI uplifts in our leases, right? So you know, in supermarkets, they're mostly capped at 4 or 5. Here they're uncapped. Now, obviously, if you get very high inflation, the government
you need to make sure it's sustainable as well because you don't want to.
But in reality, I think it was at 7, was it?
It was capped at 7 for a year, yes, and the sort of like the sort of when we started to get double digit inflation a couple of years ago, it was capped at 7 for a year, but you will normally just sort of track entirely in line with inflation. I think the government's even sort of set out that the next rent settlement's going to be for 10 years at CPI plus 1, so that gives a little bit more certainty. I mean, in theory, the rent should, just to say, you know, be entirely neutral to the registered provider, because it's effectively they're just claiming on behalf of the residents they have in situ and then passing through. So actually, the alignment in terms with CPI shouldn't cost them any more. It should actually just be net neutral to them.
And on the subject of government and policy, how do government policies around rent setting and housing standards affect the operations and profitability of the REIT?
I think, you know, clearly it's an intrinsic part of it. You know, it's what created the sector. It's what regulates the sector. It's what the RPs or our approved providers are actually sort of hyper focused on themselves. I think it's probably fair to say that, you know, when the government has come along and started to tinker with rent policies and have a look at how the sector's funded, and that's the sector more generally, social affordable housing, of which specialised supported housing is just a very small part. Quite typically, specialised supported housing just gets taken off the agenda of things to be played around with. You know, these are some of the most vulnerable members of society. The homes that are provided by Soho and also, you know, elsewhere across the sector offer huge savings to the public purse. You know, our average rents are around £230 per person per week. When you look at the costs of NHS settings, you can look quite easily to a couple of £1,000, maybe slightly more. A care home setting might be, you know, £1,000 to £1,500 a week. So the alternatives are more expensive, and therefore that actually gives a better degree of certainty that the government will continue to support it because it's the cheapest and best option.
Well, it's economical as well as socially.
And delivers the best outcomes to the residents. So it's we've tended to sort of like fare well during those conversations. It's always something that, you know, could rear its head, and we're always alive to it. And I think what we're trying to do as well, some of the part of looking at the social impact and trying to quantify that, is to actually encourage policy to actually support the sector, which I think probably could be done a bit more in time to try and continue it on continue the good that it actually delivers for sector.
I mean, we talked about the impact, and you talked about kind of how important that was for investors, and you said kind of not as much as you expected it to be. Is that just because of where we are in our economic cycle and what we have kind of in general around ESG? I mean, if you go back 5 years, I imagine it would probably be much higher up on investors' agenda. But now, kind of, how has kind of the whole ESG outlook changed from your investors' kind of perspective? Do you think?
I think it probably has retrenched after a few years. I think, you know, we'll remember, you know, during the early stages of COVID, sort of like it was front and center. There was very much a social purpose. I think, you know, society as a whole saw that. And we have now sort of switched a little bit more, probably back to the environmental side as well. I think probably the environmental crisis has risen up the agenda. I think, you know, we will continue to argue for it because we think it's absolutely key. I think it's a hard one to call just in terms of which direction it goes in. I think it's never going to hamper the long-term outlook for what we're trying to achieve. So that's why we think it's the right thing to crack on with and do anyway. But it does ebb and flow over time.
Yeah, I mean, it sounds like it's all down to governance anyway, and the long-term, it has long-term economic it all comes down to money and returns. And although it might sound like you're doing kind of ESG, actually what you're doing is you're making your income streams more sustainable and more reliable.
Correct.
So it sounds like a no-brainer, really, doesn't it?
Yeah. I mean, like the focus on the environmental side is to make sure, we're providing safe, well-maintained homes that are thermally efficient, and that's good for our residents. That we want them to be comfortable in the homes that they will, many instances, call homes for life. But we're also doing it because it's the right thing to do for the environment. But we're also doing it because it's the right thing to do from a valuation perspective, where we're starting to see, brown discounts, as they're termed, reflected in the valuation. So we want to make sure that we're not exposed to those. From the social impact side, I don't think that's quite quantified. I mean, just to pick up on the point made earlier, I think, the impact side, we think is a real key strength of what we're trying to deliver. I think some of the lack of value that investors will ascribe to the impact is probably because the impact label has been used by some of those, slightly less successful strategies, and strategies that have been mentioned, earlier in this conversation that were sort of ascribed to be providing great social impact, but then have lost quite a considerable amount of shareholder capital. So we're very careful in terms of, we're doing the right thing financially first and foremost, but we know that it delivers some really strong social impact. So that's a secondary benefit as well in terms of what we're trying to achieve.
Fantastic. And I know I saw a post, I think you're recruiting for staff in different positions at times. So what advice would you give for someone looking to start a career in real estate investment? And also, what advice would you give to someone looking to get into social housing REIT?
I mean, I think we're always really interested in these sort of assets that are really kind of underlying they have an operational business underlying them. So I think kind of really understanding the economics of the businesses that use your real estate it's not only kind of critical to value, it's also just really interesting as well. It just makes the whole thing much more interesting. I mean, I think the other thing that is really important is like learning how to actually model cash flows.
Yeah.
And it's surprising how many people in this industry can't do that. Cap rate is a very crude measure of anything. So it's for us, we always run long-term cash flow models and run lots of scenarios, and everybody understands all the assumptions behind what we're doing. So
you're not buying it for a year, are you?
No.
You're invested in it for a year.
Exactly.
So it's
exactly.
got to be
exactly. So I think those two things, really understand. That's why I do those supermarket visits that I post up on LinkedIn, because it's not only like important for the business, it's also actually pretty interesting to kind of see how different markets operate, and how they use the real estate. And it's the same here. It's understand in social housing, what does the end resident need from the property? How does that relate to government policy? How does that then generate a long-term sustainable cash flow that's actually creates a really, really interesting, attractive investment opportunity?
And you mentioned kind of on the term of your debt, so 8 years on an average of 2.75%, which I mean, listeners will be kind of
be quite good in your mortgage, wouldn't it?
Yeah, exactly. And I mean, but that's the point, isn't it? At scale, you've got this buying power. Whereas if I'm going to do a small social housing development and I'm trying to get finance once it's set up and done, I mean, we're realistically with your fees and everything like that, you're looking at a blended rate of about 7.5%.
Yeah, exactly. Yeah.
And so that's massive arbitrage there on your cost of capital.
Yeah.
If we've got listeners and people watching this who have smaller portfolios of sort of supported living and things like that, is this the sort of stock that you might be interested in buying? And if so, what is it that you're looking for, and how can they best set up their stock or portfolios for a sale to someone like Soho?
I think there's a longer shopping list than the podcast in terms of what we're actually looking at on an individual investment opportunity basis. But it goes back to all the things we've been saying. It's the right property in the right locations with a certain appropriate rental level. It's the right counterparty that we, that everyone that they should be looking to have as the right counterparty to make sure that they're going to get that sustainable income.
So on the counterparty, what is it you look for on the counterparty?
I think it's they're a range. We have organisations who might have 5 to 10 units with us. We have some that have 500 plus units with us. So that's not to say that scale is the only driver. It's one of the considerations, but you need to look at their operational efficiency. So actually just getting the feel for, how are their properties run? What's their governance like? How are they talking to their own, what are their trustees saying? How are they reporting as a board? How are they scrutinising their own governance? What does the regulator think of them, of course, to make sure that they are compliant with what they should be doing? And then having a look at the parties that they're working with as well. So, are they attracting the better care providers? So referrals from the nationwide care providers, because you tend to find that the better organisations have the better counterparties and the better relationships. So it's sort of, if it smells right, it's because they're generally sort of like working well. And then the individual properties themselves, as I said, it's not just about new build stock. It can be refurbishment stock, but it's about it being appropriate, and it's about it being well maintained, and it's about being appropriately reinvested in as well. This is not just about stripping income out of something. This is about looking after homes for not just that initial lease term, but for life effectively for those residents. So if you've got an organisation that's a good custodian of the property, the fundamentals of the property are okay, and it's set up financially in the right way, then yes, it's something that they should be happy to hold, as well as probably.
Well, it might be the cost. It might be the cost of capital point that I'm getting at, which is making it very difficult to hold. And I think there are lots of people in that boat right now that are thinking, hey, we've got this property yielding kind of 7%, but our cost of capital is nearing 8%.
Yeah.
Yes. Yeah, exactly.
This is a bit of a struggle, and actually, it's not for us right now, even though everything else is working and in place. So. I think there's definitely people out there, because I've spoken to them, who have got things set up quite well, but it doesn't work. So it's just unfortunately they're caught in that trap of having to refinance kind of in the last year or so, and before then their cost of finance was 4 or 5%, and now it's gone up and it's made that unviable. Interesting. So are there any other kind of trends or emerging trends in real estate infrastructure that you've got your eye on?
I mean, we'd really like to sort of broaden out within living as a sector. Students always interesting. Although maybe there's an opportunity there at the moment, because there seems to be there's probably more sellers than buyers of larger portfolios of a student right now. And for us, it's always about finding the right team and the right capital partner. So that's something that we're working on in the background. We're also quite interested in commercial real estate lending as a strategy. We think, I'm sure,
to all the people paying 7.5% on their on the mortgages.
I'm sure. Some of your listeners own sort of larger commercial properties, and they'll be aware that the UK clearing banks will got a very tough capital regime around lending to commercial real estate in the UK. We think that creates a bit of an opportunity. So we're looking at whether we could do something there to raise a fund that would lend on UK commercial real estate, and just do the things that are either a little bit too complicated or a little bit too high leverage for the clearing banks to look at. So those are two of the things that we're looking at as kind of medium term growth prospects for Atrato. Interesting.
Well, I know most of the listeners and my ears have pricked up there on the lending front, so I'm sure we'll have to have a chat once we turn off the cameras about that. But brilliant. Well, guys, thanks so much for coming on. It's always a pleasure to speak to you, and I've learnt loads about it, and I'm sure we'll have to get you back on soon.
Well, thank you very much. Pleasure to be here.
Cheers.
Thanks, Phil.
Thank you.